Welcome to the Market Dossier for the week of June 15th to the 19th, 2026. This video covers the post-witching recap, the June swoon, and the outlook following a record-breaking options expiration. The tide just went out. Following the biggest options expiration on record, we are entering the undertow. With record whale prints, a dollar breakout, and a seasonal window that frequently traps bulls, caution is advised. This video provides a framework, not a forecast. We remain neutral on direction, mapping macro factors and flows to prepare for any outcome. Data is sourced as of June 19, 2026. Remember, this is for educational purposes only, and not financial advice. Our thesis: while the surface seems calm with pinned levels and low volatility, a dangerous current lies beneath. Driven by a dollar breakout and seasonal risks, this is not the week to assume stability. We utilize a three-pillar framework for our analysis: macro to set the weather, flows and positioning to identify the footprints, and technicals to select our entry and exit points. At a glance, the market appears strong, with the S&P 500 pinned at 7,500 and a calm VIX. However, underlying indicators like a rising dollar and record volume suggest more red flags than we have seen all year. In our first pillar, macro, we analyze the current global climate, which serves as the overarching weather pattern for every trade we make. Is the market still bullish? While major indices continue to hit higher highs, gains are narrow and concentrated. We respect the trend, but recognize that current leadership is crowded. We examine the June swoon, a recurring soft patch in late June. While recent years have seen this trend bucked, this year's alignment with massive volume and record OPEX suggests increased caution. Why could this period be particularly volatile? We are seeing four major catalysts stack up: record options expiration, record volume, a hawkish shift from the Federal Reserve, and a significant dollar breakout. The mechanics of this volatility window are clear. Post-OPEX, the dealer leash is removed, and with a holiday weekend approaching, we expect the next 10 sessions to potentially move faster than the previous 10. Under new chair Kevin Warsh, the Fed has initiated a regime change. By holding rates steady while removing easing-leaning guidance, the Fed has signaled a pivot that the market is beginning to process as increasingly hawkish. Visibility is decreasing as the Fed moves away from traditional forward guidance. With 5 new task forces established, the market is receiving fewer signposts and must learn to trade the data directly. The dot plot has flipped. The expectation for rate cuts has largely vanished, with officials now projecting rates to remain flat or move higher through 2026. The market came for cuts, but is facing hikes. Finally, the path forward shows a rate hike is now fully priced in by October 2026. Higher for longer has evolved into a new baseline, reflecting a significant shift in market perspective. Moving to the dollar, we have seen a breakout to around 101, its highest level since May 2025. This move, fueled by a hawkish Fed and strong jobs data, marks a potential genuine trend change. A dollar breakout is a classic risk-off signal. It generally correlates with tighter global conditions, pressure on commodities, and can create headwinds for the equity market that most investors often overlook. The yield curve is telling a story. While the 2-year yield is hitting higher highs due to Fed policy, the 30-year is falling. This split suggests the market is pricing in future economic weakness, a common late-cycle signal. Inflation remains a persistent challenge, well above the 2% target. With a solid labor market and the Fed revising forecasts due to geopolitical shocks, there is currently little cover for policy easing. Crude oil is our wild card. With an interim deal easing tensions in the Strait of Hormuz, prices have cooled towards $76. This remains the most significant variable in the inflation and rate debate. Midterm election years often feature a choppy summer before a stronger finish. We are watching for the seasonal calm to potentially give way to earnings-driven volatility as we head into the second half of the year. History suggests a rocky path during a new Fed chair's first months. Markets are currently testing the new regime, and we should expect continued structural wobbles before the market settles into a new rhythm. The current market environment rhymes with 1998 to 2000. While hypergrowth can drive extended rallies, any questioning of the underlying moat can lead to rapid, brutal repricing. Speed is the key takeaway here. Our framework compares current conditions to past eras. Whether it mirrors the 98 melt-up or a 2000-style unwind, we are focused on watching bond market signals to navigate the uncertainty. We must also consider the role of human nature. The pressure on advisors to chase high-performing sectors, combined with corporate FOMO, can often extend a cycle well beyond traditional valuation metrics. Looking ahead, earnings and IPOs will dictate the year. With a major IPO window opening and key earnings reports on the immediate horizon, we anticipate market sentiment will remain highly sensitive to performance. Our guiding principle remains: respect the trend until market structure proves otherwise. Bearish signals are currently present, but we wait for price to confirm a change in character before taking a stance. Our macro scorecard shows a complex landscape. The trend is technically intact but narrow, the Fed is hawkish, and seasonality is signaling caution. We remain vigilant. Our second pillar shifts from macro to flows and positioning. Understanding these footprints is essential for navigating the current environment. Dark pools provide insight into where institutions are moving large blocks of capital. While we see these footprints with a delay, the recent volume is historically significant, indicating major shifts under the surface. We are tracking a massive $14.6 billion in volume across 38 prints on SPY. Flow trackers highlight this as the fourth largest cluster since SPY's inception, making it a rare and critical event that warrants a close look. What does this cluster mean? It could be ETF rotation, liquidity provision, institutional positioning for upcoming volatility, or simply mechanics related to the quarterly options expiration. We focus on price action to reveal the true intent. The SpaceX IPO made history. With $75 billion raised and over 500 million shares traded on debut, it became the sixth largest U.S. company overnight. The initial retail demand was overwhelming, setting a new benchmark for IPOs. Flows for SpaceX remained off the charts, with a single $9 billion print at the close of its debut week, a record for a brand new listing. Following the initial surge, shares consolidated, testing the resolve of early buyers. Should we track SpaceX options? With a spot range between 160 and 180, and a call wall forming near 225, a new options ecosystem is taking shape. It is a battlefield worth adding to your watch list. Examining the broader tape, leadership remains strong in semiconductors and hardware, driven by ongoing AI infrastructure spending. Meanwhile, consumer goods show risk-on sentiment, and systematic quant flows continue to rotate under the surface. The semi and hardware bid represents the cleanest expression of the AI build-out. Wall Street participation remains essential to maintain performance, keeping a structural bid under these groups, even at elevated valuations. Warning: a sixth Hindenburg omen has fired in the current cluster. While individual omens are often noisy, clusters flag internal divergence. We continue to look for price to confirm whether this is a precursor to a shift. Retail cash allocations are near historic lows, suggesting investors are nearly fully deployed. With margin debt accelerating to chase the market, this level of late-cycle froth can persist, but it creates significant fuel for a potential correction. The real tell remains the bond market. As long as debt markets stay calm, equity sell-offs are often liquidity traps rather than structural tops. When bonds finally signal a genuine panic, that is when we pivot to defensive. Gold recently saw widespread capitulation, with significant ETF outflows hitting major technical levels. Sharp falls often precede the formation of durable bottoms, so we are watching closely for signs of stabilization. Seasonally, gold often finds strength between June and July. However, mining stocks can face headwinds later in the fall. We are looking for structure and stability in the charts before considering an entry. Bitcoin ETF flows remain weak, showing only fleeting positivity. With price slipping below the daily 20-day moving average, the lack of significant inflows suggests the asset needs more time to build a solid base. Under the hood, equal weight indexes are recovering, indicating broader market health. Sectors like financials and industrials are grinding higher, suggesting the current rally is not just a narrow story of a few tech giants. Finally, the Russell 2000 continues to outpace the megacaps, with biotech and banks leading the charge. This strength in small caps is a positive signal for the broader market sustainability. The recent Kospi sell-off served as a live preview of volatility in the semiconductor space. We saw names drop over 20% in a rapid capitulation. It echoes the 1998-99 period, where any doubt in growth leads to violent repricing. Remember, volatility works in both directions, so watch your speed. We are witnessing historic size in the markets. We have seen new record-setting activity across major ETFs and a record IPO, all within a very tight window. This kind of outlier volume often precedes significant volatility. It's an exciting time, but one where disciplined trading is more important than ever. Here is our current flows scorecard. We are seeing top-tier whale prints in SPY, while the recent record IPO is beginning to cool. Risk-on themes remain narrow, and while there's talk of a Hindenburg cluster, it remains unconfirmed. Retail leverage is high, and bond markets are currently acting as a haven for dip buyers. Moving into the technical pillar. This is where we break down the cross-asset level maps to see where structural support and resistance actually live in the current environment. Despite some noise, the tape remains fundamentally bullish. Major indices like the S&P, Nasdaq, and Russell are holding their higher high and higher low structures. Weekly closes were not bearish, showing significant upper wick rejections rather than breakdowns. We need to see a clean lower low to turn bearish, which we haven't seen yet. Looking at the S&P 500 level map, 7,500 remains our critical equilibrium point, acting as a pin between major call and put walls. Levels above look towards 7,560 and 7,650, while below, we watch 7,420 and 7,300 for support. Above 7,500, the bulls remain in control. Below that line, the air thins. Recent market commentary has effectively filled the open gaps on the S&P and Nasdaq, clearing out many of the magnets that were previously pulling price around. While some lower gaps remain, this housekeeping removes several anchors, potentially allowing the market to move more freely than it has recently. Here is the full S&P 500 ladder for your reference. These zones highlight where buyers and sellers have historically shown interest. Again, remember that these are reference points, not predictions. Our core thesis holds that the bulls own the market above 7,500, while a breakdown scenario targets the 7,300 to 7,000 zone. The Nasdaq is showing real strength with a fresh higher high. Semiconductor leadership fueled the comeback from the recent dip, and the index has successfully filled its outstanding gaps. Despite some intraday weakness, the weekly structure remains constructive. Respect the new highs the Qs are making. This is the full Nasdaq ladder. The current level sits near 26,500. We are watching 26,800 and 27,200 as key upside targets, with support identified at 26,000 and the 25,500 gap fill zone. Remember, tech leadership drives this move in both directions, so use these levels for orientation as you trade. Why was 7,500 such an important pin? Dealers managing option hedges to stay neutral essentially create a gravitational pull toward strikes with high open interest. By closing right between major call and put walls, the market pinned 7,500, letting those puts expire worthless. With expiry cleared, that specific dealer-driven gravity is now gone. The Russell 2000 is our primary breadth indicator. Currently trading at 2,980, it remains in a strong structural setup of higher highs and higher lows. Small cap leadership is a bullish signal for broader market participation. Keep an eye on 3,020 and 3,080 on the upside, and maintain a close watch on the 2,900 and 2,820 support levels. The US dollar is showing the cleanest trend on the board right now. After a double bottom earlier in the year and a test of resistance, the index has broken out of its prior range and established a clear trend of higher highs and higher lows. A confirmed weekly close here suggests further movement toward the next equilibrium level. Here is the DXY level map. Holding the 100 level is critical to maintaining risk-off pressure across assets like metals and crypto. The 102.7 level serves as our next target, while 98.4 is the vital breakout origin point. Losing 98.4 would signal a failure of the current breakout. Finally, the yield map. The 2-year yield, driven by Fed policy expectations, remains in a trend of higher highs and higher lows following the hawkish hold. In contrast, the 30-year yield is falling, reflecting market concerns about future growth. This divergence between the front and long end of the curve is a classic indicator of late cycle conditions. Let's pivot to gold. The metal is currently facing technical headwinds, rejecting the daily 20-day moving average. This suggests supply is currently in control at this trap level. We are seeing a fade after tagging supply on the 2-hour chart, currently resting near the 0.618 Fibonacci level. For gold, the path forward is clear. We need to reclaim and hold above the $4,400 level with established structure. Gold has dipped into an important demand zone, which bears watching. A clean swipe lower before a recovery would provide a higher odds setup than a direct move. Here is the full ladder for gold. We have critical levels ranging from 4,600 as a recovery extension down to 3,650 for deeper capitulation. Notice that losing the 3,950 demand zone would signal significant weakness. Remember, a flush into demand that recovers is more bullish than a slow grind. Turning to silver, the daily 20-day moving average is the primary story here. The metal is currently leaning on hidden demand from earlier 2-point bases. We have seen multiple touches at this level, and now it faces a critical test. Breaking back above this line would flip the short-term trend. The mantra for silver remains simple. Above the 20-day moving average, the metal works. Below it, it is best to stay patient and wait for the structure to solidify before engaging. Gold miners, represented by GDX, are facing a supply rejection. After dropping and bouncing into supply, the group is pulling back. There are notable gap fills around the $80 area. We are seeing massive outflows, which currently reflect capitulation rather than accumulation. Keep in mind that miners often lag the metal and can weaken further with broader equities later in the year. The rule here is simple. Metal first, miners later. Avoid the temptation to front-run a laggard group. Bitcoin is currently struggling with structure, having fallen off the daily 20-day moving average. Flows are weak, and we are not seeing clear buyers stepping up yet. It likely requires more time and a proper base formation before it can attempt a trend reversal. With Bitcoin, the rule is, no structure, no trade. It is best to let the market show its hand, rather than trying to force a position. Crude oil is in a clear downtrend, printing lower lows and lower highs. It recently undercut a prior low, with news influencing the move. Lower oil prices are generally disinflationary, which is favorable for the Fed's policy debate. However, the longer crude stays low, the more pressure builds on energy stocks. Falling oil acts as both a quiet ally against inflation and a headwind for the energy sector. We are watching the $76 level for continued movement. Copper is currently range-bound, suggesting the market is undecided on the growth outlook. Dr. Copper is a key leading indicator for the economic cycle. A breakout to the upside would confirm real economic expansion, while deregulation and capital expenditure themes remain key narratives to monitor. Watch copper for the growth all clear, or as a potential warning sign for the broader economy. SpaceX is the new battlefield for traders. Brand new listings are notoriously volatile, with thin structure and high emotion. The key levels to watch include the $225 call wall, the $185 post-IPO high, and the $135 IPO floor. It is best to wait for a range to build. Remember that new IPOs represent pure price discovery. Levels will firm up over weeks, not hours. Holding the IPO price will be your first real tell on the stock's future direction. Let's review what could potentially kill the current bull thesis. First, a genuine credit market panic. This remains the definitive signal that shifts a dip into a market top. Stay alert for signs of stress in credit, as that's often where the real trouble begins. Second, watch for a clean break of the current index structure. We want to see both a lower low and a lower high occurring together. That structural shift is the primary warning sign that the trend is no longer intact. Third, monitor the dollar. If it accelerates rather than consolidating at the breakout, it creates a headwind for equities. Fourth, keep an eye on semiconductor and hardware leadership. If these engines stall, the rest of the market will struggle to maintain its pace. Finally, we have the July earnings season approaching. Stumbles from the megacaps as the season opens could serve as a catalyst for a market reversal. Remember, these are 5 things to watch. None are confirmed yet, which is exactly why they are on our watch list. Now, let's talk about survival and risk management. Post-event windows combined with a long weekend always introduce gap risk. Do not try to guess the price. Size your positions appropriately for the gap, not just the chart structure. A normal stop is a fantasy during a holiday gap. You must define your risk before the event, not after. The highest probability edge in these scenarios is the reaction to the news, not trading the rumor. Let the tape do the voting. Always use smaller size into binary events. Only increase your position once the market structure confirms your read. And never forget, cash is a position. Choosing to sit out a coin flip trade is a hallmark of a professional trader. Looking at the upcoming earnings calendar, Micron is the first major stop. It provides the cleanest read on the AI memory space. FedEx also reports, giving us a vital look at the real economy freight and shipping conditions. After those, the July megacap season opens. This will be the true test of the current market's ability to keep the melt-up alive. Remember, earnings, not just the expiration cycle, will decide whether this trend extends or finally tops out. Regarding the economic calendar, we are looking at a quiet start, following the long weekend. Throughout the week, inflation-adjacent data will gradually build. Keep a close watch on the Q1 GDP revision for a look at past growth momentum. The headline release will be the May core PCE. As the Fed's preferred inflation gauge, this is the single number most likely to shift the current rate debate. In a low VIX post-expiration environment, expect the market to react loudly, even to quiet calendar events. The bottom line is this: the trend is up, but the warnings are very real. The next 10 days will reward those with discipline, not those showing bravado. Higher highs and higher lows get the benefit of the doubt, but maintain your focus on structure. Watch the undertow, the dollar breakout, the Hindenburg cluster, and the seasonal swoon window. As long as bond markets remain calm, dips will likely be bought. If bonds panic, change the plan immediately. Trade the reaction, not the forecast. To wrap up our 3-pillar verdict, macro shows a trend that is up, but the weather has turned. Flows reflect historic size but come with warnings. Technically, the market remains bullish with a dominant dollar, though the seasonal swoon window is open. Respect the trend and the data. Remember, the final takeaway is clear. Watch the bonds. They remain the real risk indicator. Keep your focus on the levels, maintain your discipline, and let the market structure make the decisions for you. Thank you for joining us for this operation.